All right, guys, welcome to the Bat Out of Debt Show. We're live on YouTube another Sunday morning. Patrick Doherty in the house, a resident accountant for a prestigious accounting firm in Los Angeles. And you guys know me, I'm Troy Johnson, coming to you live from, I'm still in Virginia, but coming to you live from Virginia. We're going to share some exciting stuff today, Patrick. How are you today before we get into this show, my friend?
Oh, doing marvelous. It's beautiful and sunny California. Southern California, that is.
Yeah, it's beautiful here in Virginia as well. Today, we're going to talk about the 10-year interest rate, price to sales ratio, the PEG ratio, and how that is important in an inflationary market. So let's start the show. All right, guys. Good morning. Good morning. Feel free to join us in the chat. Say what's up. If you have any questions, hit us in the chat. We're live, and we would love to answer your questions. We're going to start the show off and get right into this inflationary environment. It's crazy, the market, how it is right now. And if you're in the market this past week and saw what happened to some of our favorite stocks, you would really want to understand what Patrick is about to talk about, and that is an inflationary environment. And what does that mean? What is an inflationary environment, Patrick?
An inflationary environment is an environment where you're seeing a significant rise in the overall cost of living. So things that you see at the grocery store might be going up in value. Gas is going up in value. Real estate, of course, and rents. So consumer staples.
Yeah, and one of the key metrics for that rise in price is the 10-year treasury yield. So Patrick, what he's going to do now is share why the 10-year treasury year is so important for an inflationary market and why that is an indicator. So Patrick, would you like to take over and do that?
Yes. So first of all, I just want to say that the 10-year treasury yield is a response to a market response to higher inflation, and then ultimately that gets locked in by the Federal Reserve monetary policy. But anyways, let me jump into the 10-year treasury note real quick.
Now Patrick is going to share, and I've always been curious, why is the 10-year, why is that the benchmark, and where did that all come from? So this will be a really good show, Patrick, to kind of share some of what you found out here. So
okay, so I'm sharing my screen right now.
Yes, sir.
And so can you see the screen right now?
Yep, sure can.
Okay, great.
If you would like to blow up the text, that would be perfect.
Okay. Okay, so this is good here.
Yep.
So this is, again, another article by Investopedia. Again, that's a really good source for investment education and investment articles or anything about the economy. So why is the 10-year U.S. Treasury yield matters? And this is an article by Christina Zucchi, who's one of these contributors to Investopedia. And the Treasury bond yields or rates are tracked by investors for many reasons. The yields are paid by the US government as interest for borrowing money via selling the bond. But what does this mean? And how do you find yield information? Okay, let me kill this. Sorry, apologize. This ad's getting in the way. But anyways, Treasury bills are loans to the federal government that mature at terms ranging from a few days to 52 weeks. A Treasury note matures in 2 to 10 years, while a Treasury bond matures in 20 to 30 years. The 10-year Treasury yield is closely watched as an indicator of broader investor confidence. Because Treasury bills, notes, and bonds carry the full backing of the US government, they are viewed as the safest investment, and hence, this is the reason why it's such a benchmark. So now, some of the key takeaways this article will provide is the Treasury securities are loans to the federal government. Maturities range from a few weeks to as many as 30 years, as I was just mentioning. Because they are backed by the US government, Treasury securities are seen as a safer investment relative to stocks. Bond prices and yields move. Let me get back to that. Bond prices and yields move in opposite directions. Falling prices boost yields, while rising prices lower yields. The 10-year yield is used as a proxy for mortgage rates. It's also seen as a sign of investor sentiment about the economy. A rising yield indicates falling demand for Treasury bonds, which means investors prefer higher risk, higher reward investments. A falling yield suggests the opposite. Why is the Treasury yield so important? The importance of the Treasury, the 10-year Treasury yield bond goes beyond just understanding the return on investment for security. The 10-year is used as a proxy for many other important financial matters, such as mortgage rates. This bond also tends to signal investor confidence. So the U.S. Treasury sells bonds via auction, and yields are set through a bidding process. When the confidence is high, that means that when the economy is very strong, the prices for the 10-year bond drops and the yields rise. This is because investors feel they can find higher returning investments elsewhere and do not feel they need to play it safe. So they might, again, invest in risk on, as you will hear on CNBC, riskier assets such as common shares, maybe cryptocurrency, and other speculative investments. But when confidence is low, bond yields rise and yields fall as there's more demand for the safe investment. And hence, what you saw on Friday during the scare of a new COVID variant, and this one potentially more transmissible and deadlier than the current strain, which is the Delta variant. They feel that that's going to cause a whole bunch of travel restrictions and shutdowns, and as a result, the stock market fell precipitously on Friday, and as a result, investors dumped all of their money or much of their money into the Treasury, U.S. Treasury bond as yields fell for that day. So hence it was a flight to quality. This confidence is also felt outside of the U.S. as again you have this uncertainty in the risky assets, and international markets also fell. The geopolitical situations of other countries can take the U.S. bond prices as seen as a safe haven for capital. Again, this is the flight to quality. This can push up prices of the U.S. government bonds as demand increases, thus lowering yields. Again, these are people who want to play it safe because they see, again, what happened on Friday with the, with the COVID scare. More and more people selling stocks and buying safer, higher quality securities such as 10-year Treasury bonds. Another factor related to the yield is the time to maturity. The longer the Treasury bond time to maturity, the higher the rates or yields, if you will, because investors demand to get paid more the longer their money is tied up. Typically, short-term debt pays lower yields than long-term debt, which is called the normal yield curve. But at times when the yield curve can be inverted with short-term maturities paying higher yields. And this is where they expect a rapid rise in interest rates on the short term because they feel that the Federal Reserve will rise interest rates quickly just to cool down the economy if it's really inflationary. And thus you will see shorter term paper more competitive with longer term paper. So changing yields over time, because the 10-year yields are so closely scrutinized, knowledge of a historical pattern is integral to understanding how today's yield fare as compared to historical rates. Below is a chart of the yields going back a decade. So, in conclusion to this discussion on 10-year yields, the 10-year yield is still relatively low as compared to as it was back in 2012.
All right, Patrick. So said a mouthful there about yields. So
Mm-hmm.
so the 10-year is the benchmark for inflationary. And when you see TV a lot, you look at these shows, they're always talking about an inflationary environment, I labeled the name of this show on the thumbnail, which will be out shortly. When interest rates are high, stocks will die. When interest rates are low, stocks will grow. And that's the axiom that I was taught some 30 years ago. Repeat, when interest rates are high, stocks will die. When interest rates are low, stocks will grow. What that means is high value, I would say valuation stocks that have a high PE ratio, stocks that are priced very inflated will die in a high yield 10-year inflationary environment. But stocks with lower valuation or PE ratio or metrics that evaluate that, they will fare better in an inflationary environment. So let's go over, Patrick, some of the key metrics that one should look at in an inflationary environment so that people will understand, well, what is expensive versus what is cheap, so that they can make
Yeah.
that analysis in this type of market. You have a comment to that before we go into the metric?
Yeah. So just to simplify the adage of stocks when interests are high, stocks will die. When interest rates are low, stocks will grow. It's the meaning of that is that analysts use this 10-year treasury yield to value stocks, and as yields go higher, they calculate that stocks will be cheaper. When the yield goes lower, analysts predict that stocks will be higher. That's all.
Right. And I love the way you said that because based on that, if interest rates are higher,
Hmm.
then stocks that are overpriced get cut quicker.
Hmm.
And you cannot,
Exactly.
and so rookie investors, they value a stock based on the stock's price per share. Like this stock, like Tesla, cost $1,000 per share. Where more seasoned investors look at the metrics that we are about to go in to evaluate stocks. So
Hmm.
that's the key. Hold on for a second, Patrick. Let me pop something up. We got a person repeating the axiom. Miss James was repeating that. So let's look at some of those metrics. Thanks for the thumb up. Thank you. Thank you. Appreciate that. Let's look at some of the metrics to evaluate companies in this inflationary environment. So, Patrick, let's talk about the first one. Let's talk about price to sales. What is price to sales? And how do we use price to sales in this inflationary environment to keep ourselves out
Okay.
of trouble for getting our stock cut off and our share price falling for investing in the wrong companies?
Right. So let me share the screen on an article here. And do you have this?
Yes, sir. Blow it up, please,
Okay.
Patrick, for the cell phones. And let's get into our favorite source, Investopedia.
Yes.
And,
So I
and,
think
and the
this is a.
reason why, and Patrick, I think it's important to share the reason why we share Investopedia and stuff. We want you to be able to fish for yourself. So if there are some terms that we're using or something you're confused by when you're watching CNBC or something, just go to Investopedia and look it up. It's really that simple. But please, Patrick.
Okay. So I think this is as good as I can get it without ads interrupting my flow in terms of blowing this up. But anyways, um, how to use price to sales ratios to value stocks, and this is by another contributor, Ben McClure. Investors are always seeking ways to compare the value of stocks. The price to sales ratio utilizes a company's market capitalization and revenue to determine whether the stock is valued properly. So, how the price to sales ratio works. The price to sales ratio, i.e., PS, is calculated by taking a company's market capitalization, that is, the number of shares outstanding, multiplied by the share price and divided by the company's total shares or revenue over the past 12 months. The lower the PS ratio, the more attractive the investment. Price to sales provides a useful measure for sizing up stocks. How the PS is useful. The price per sales ratio shows how much the market values every dollar of the company's sales. This ratio can be effective in valuing growth stocks that have yet to turn a profit or have suffered a temporary setback. For example, if a company isn't earning a profit yet, investors can look at the PS ratio to determine whether the stock is undervalued or overvalued. If the PS ratio is lower than comparable companies in the same industry that is profitable, investors might consider buying the stock due to the low valuation. Of course, the PS ratio needs to be used with other financial ratios and metrics when comparing whether a stock is valued properly. In a highly cyclical industry such as semiconductors, there are years when only a few companies produce any earnings. This does not mean semiconductor stocks are worthless. In this case, investors can use price to sales price instead of the price earnings ratio or PE ratio to determine how much they are paying for a dollar of a company's sales rather than a dollar of its earnings. If a company's earnings are negative, the PE ratio is not optimal since it will not be able to value the stock because of the denominator is less than zero. The price per sales ratio can be used for spotting recovery situations or for double checking that a company's growth has not become overvalued. It comes in handy when a company begins to suffer losses and as a result has no earnings which investors can assess the shares. Let's consider how we evaluate a firm that has not made any money in the past year. Unless the firm is going out of business, the PS will show whether the firm's shares are valued at a discount against others in its sector. Let's say a company has a PS of 0.07, while its peers have an average of 2.0 for the PS. If the company can turn things around, its shares will enjoy a substantial upside as the PS becomes more closely matched with those of its peers. Meanwhile, a company that goes into a loss, i.e., negative earnings, may also lose its dividend yield. In this case, PS represents one of the last remaining measures for valuing the business. All things equal, a low PS ratio is good news for investors, while a very high PS could be a warning sign. To me, that's subject to interpretation. Where the PS falls short. That being said, turnover is valuable only if at some point it can be translated into earnings. Consider construction companies which have high sales turnover, but with the exception of building booms, make modest profits. By contrast, a software company can easily generate $4 in net profit for every $10 in sales revenue. What this discrepancy means is that sales dollars cannot always be treated the same way for every company. Some investors view sales revenue as a more reliable indicator of a company's growth. Although earnings are not always a reliable indicator of a financial health, sales figures can also be unreliable too. Comparing companies' sales on an apples-to-apple basis hardly ever works. Examination of sales must be coupled with a careful look at profit margins and comparing the findings with other companies in the same industry. So, hence, the ultimate goal of a firm is to generate cash flow. And the long-term way of generating cash flow is to be net profitable. So having positive earnings in the long run will generate high cash flow and hence deliver shareholder worth in the long run.
Yes, yes. And we keep repeating that. Earnings is
Yes,
just a fancy word for profits. Go ahead.
Yes. And then to go on further, debt is a critical factor. The price to sales ratio does not account for the debt on the company's balance sheet. A firm with no debt and a low PS metric is more attractive investment than a firm with high debt at, and the same PS. At some point, the debt will need to be paid off, and the debt has an interest expense associated with it, especially when interest rates are moving higher in terms of having to refinance some of that debt. The price to sales ratio as a valuation method does not consider that companies with high debt levels will ultimately need higher sales to service the debt. Companies heavy with corporate debt and on the verge of bankruptcy can emerge with a low PS. This is because their sales have not suffered a drop while their share price and capitalization collapses. Excuse me. So how can investors tell the difference? There is an approach that helps to distinguish between cheap sales and less healthy debt burdens. Use the enterprise value, as we were discussing in a previous show, for sales rather than the capitalization for sales. That's market capitalization for sales. Enterprise value includes a company's long-term debt into the process of valuating the stock. By adding the company's long-term debt into the company's market capitalization and subtracting out any cash, one can arrive at the enterprise value. So, and in the long run, the enterprise value is the total cost of buying the company, including its debt and leftover cash.
Yep.
So, to finish off, the bottom line is, as with all valuation techniques, sales-based metrics are only part of the solution. Investors should consider multiple metrics to value a company. A low PS can indicate unrecognized value potential, so long as other criteria exist, like high profit margins. Again, that's so important, because that's going to generate cash flow. And again, as I repeat myself over and over, that's going to translate to stockholder wealth.
Yeah. And the price of a stock is based on the profits it's made. So you can sell all day, but if you're losing money, you're going to go out of
Yeah.
business.
Well, it's also largely calculated on the cash flow, like free cash flow to the firm, which would include primarily the profit margins and cash flow from operations. So, anyways, so we have
Patrick,
that.
super heavy, Patrick. Super heavy upstairs. Continue, sir.
So low debt levels and high growth prospects are also very important. Otherwise, the PS can be a false indicator of value. So there you have it.
All right, Patrick. So price to sales. We're going to go over some price to sales of some of our favorite companies in the end. But the key takeaways, Patrick, if you have your new companies that have not been out as long, or you have your companies like Amazon, who traditionally spends a lot of money and can control whether they are profitable or not because they invest in space, rockets and all kinds of things. You can look at the sales. It's hard to fudge sales. Either you sold something or not. And how is the price of that stock in comparison to what they're selling?
Yes.
Okay. So, any takeaways on that and before we go into our next ratio?
Not really.
Okay.
I think sales is good for beginning companies that are just starting out, just compared to maybe other companies in the same industry, other companies that are in the same boat. And to me, in the get go, comparing apples to apples might be very important. You might want to compare, for example, Rivian to
Neo.
maybe Lucid.
Yeah, Lucent or Neo. And
Yes, exactly.
NVIDIA, which we will talk about shortly, to AMD.
Right.
Disney, which we will talk about, to Netflix, since Disney is
Exactly.
getting valued like Netflix, which that's the opportunity. But continue, please, sir.
Okay. So otherwise, let's move on to
Our next
the
metric,
the
that
next
is,
metric.
and we're only going over two today. So we'll go over the two that we like a lot. It's price to sales, the second metric. I've been bringing this up like weekly. The PEG ratio. How do you
Yes.
price a company and know it is cheap or not? We often look at the PEG ratio. So, Patrick, let's go into that.
Okay. So it's going to show the screen right now. And can you see this? What I'm showing right now?
Yes, sir. We can
Okay.
see it. And let me, yep, you are up, my friend. Let's do it.
Good. All right. So we have Investopedia article. Once again, a great source of investment knowledge. And this is an article by Will Keaton, another contributor. And this is dated October 6, 2021. The title is Price Earnings to Growth Ratio. So, what is the price earnings to growth ratio, or PEG for short? The price earnings to growth ratio, PEG ratio, is a stock's price to earnings ratio divided by the growth rate of its earnings for a specific time period. The PEG ratio is used to determine a stock's value while also factoring in the company's expected earnings growth. And it is thought to provide a more complete picture than the more standard price to earnings ratio. And here are the key takeaways
Now,
of this
Patrick,
article.
before we go into the key takeaways,
Yes.
I'm always hopping on PE ratio, PE ratio, PE ratio. I even did a segment like back in the spring on the PE ratio. It is important to look, it's more important to look at the PEG ratio than the PE ratio.
Well, I think what the PEG ratio does is that it puts the PE ratio into perspective. Um, the PE ratio, so, you're basically multiplying the price to the earnings per share, but it ignores the growth of that industry. So, for example, you might want to look if a stock may have like a really high PE ratio, maybe it has a 70, 80 times PE ratio.
7 to
But
80
then,
times earnings to be exact. That's what the PE ratio is, how much you are willing to pay above the earnings.
yeah.
That's how the price of a stock is determined by the PE ratio. The price above the earnings that you're willing to pay. So continue, please. Go ahead.
So let's just say that, for example, it's roughly 75
Here's the
PE
PE
ratio.
ratio.
I'm just throwing out, like a
Yeah,
fictitious number.
yeah.
But then, if the company is growing at 37 and a half times, right?
37.5% earnings.
Yeah,
Yeah.
yeah, 37.5%. Sorry, I stand corrected. Yes, that is a PEG ratio of only two, because you divide 37 and a half into 75. That's a PEG ratio of two. Well, just on paper, that 75 PE ratio may seem expensive, but then dive deeper, you look at the growth rate. A growth rate of 37 and a half, which would be maybe some of the semiconductor stocks, maybe some of the metaverse stocks. That's considered reasonably priced because the PEG ratio is only two.
Yeah. Good point. What about if the multiple, the P ratio is 70,
Yes.
and the growth of the earnings projected for the following year is 70%? That would make a PE ratio of 1. That would be really attractive for such a growth company.
Yes.
to the PE ratio to only be one is trading only one times the growth. So that's what this this PEG ratio stuff is. How much are you willing to pay times the growth? One times growth, two times growth, five times the expected growth rate, just to cut to the chase. That's what a PEG ratio. So you could price metric wise multiple times earnings, PE ratio, or multiple times growth of the company, which is PEG. But I wanted to cut to the chase a little bit so that as you read, Patrick, it will sink in with our audience, and hopefully that made sense. And if it did, hit a like, hit us in the chat, let us know. We'll slow down. But go ahead, Patrick.
Okay. So let me go to the key takeaways. So the PEG ratio enhances the PE ratio by adding in the expected earnings growth in the calculation. So as I was saying, it dives deeper into that PE metric. The PEG ratio is considered to be an indicator of a stock's true value, and similar to the PE ratio, a lower PEG may indicate that the stock is undervalued. The PEG for a given company may differ significantly from one reported source to another depending upon the growth estimate used in the calculation, such as a 1 year or a 3 year projected growth. And here's how we calculate the PEG ratio. So the PEG ratio is the PE ratio, that's the price divided by the earnings per share. So the PE ratio divided by the earnings growth. EPS, as you may know, is equal to the earnings per share. To calculate the PEG ratio, an investor or analyst needs to either look up or calculate the PE ratio of a company in question. The PE ratio is calculated as price per share of the company divided by its earnings per share, EPS, or price per share / EPS. Once the PE is calculated, find the expected growth rate for the stock in question, i.e. Yahoo Finance is a good source, or you might want to listen to the investor conference calls sometimes, or follow some of you go to Morningstar too. Using analyst estimates available on financial websites that follow the stock, i.e. Morningstar is a good source. Plug the figures into the equation and solve for the PEG ratio number. And the accuracy. As with any ratio, the accuracy of the PEG depends upon the inputs used. So basically, garbage in, garbage out. So the numbers that you use have to be very, very reliable and from reliable sources.
Good point. Good point.
When considering a company's PEG ratio from a published source, again, when a pub Morningstar is a good source, it's important to find out which growth rate was used in the calculation. In an article from Morgan Stanley Wealth Management, for example, the PEG ratio is calculated using the PE ratio based on current year data and the 5-year expected growth rate. Using historical growth rates, for example, may provide an inaccurate PEG ratio if the future growth rates are expected to deviate from a company's historical growth. And one example of that would be Ford. Ford, for maybe 3 or 4 years, had declining prospects, declining growth, until Jim Farley came into the picture and turned things around. So, to me, the growth prospect of Ford has absolutely done a 180 degree from where it was before Jim Farley joined the company. And Jim Farley has recruited some very key people. This is a man who is a visionary in terms of turning Ford into a company that does just-in-time inventory system, EV, electronic vehicles uh, focus or interest, anyways. And again, just streamlining um, the overall functions and executions of the company. So right now, the stock price reflects that, and as analysts would say, the growth prospects have dramatically improved since Jim Farley took over as CEO. The ratio can be calculated using a 1 year, 3 year, or 5 year expected growth year, for example. To distinguish between calculation methods using future growth rate and historical growth rate, the terms forward peg and trailing peg are sometimes used. What does the price earnings growth ratio tell you? The peg ratio, that is. While a low PE ratio may make a stock look good, to make look while a low PE ratio may make a stock look like a good buy, factoring in the company's growth rate to get the stock's peg ratio may tell a different story. The lower peg ratio, the more a stock may be undervalued given its future earnings expectations. Adding a company's expected growth into the ratio helps to adjust the results for companies that may have high growth rate and a high PE ratio. The degree to which a PEG ratio results indicates an over or underpriced stock varies by industry and by company type. As a broad rule of thumb, some investors feel that a PEG ratio below 1 is desirable.
I am that person. But that's not always the
Yes,
case. But I am that person. I look for that below one peg ratio company, but sometimes that's not the best, you know?
sometimes, especially if somehow analysts are feeling that the price of stocks just not performing.
Right. It's below
Uh,
one for a reason, right? But
it's below 1 for a reason. Yeah,
let's continue, sir.
exactly. And we will go into the industry comparables in another slide. According to a well-known investor, Peter Lynch, who ran the very, very successful Fidelity Magellan Fund and was able, one of the few analysts, to beat the S&P 500 on a consistent basis. A company's PE and expected growth rate should be equal, which denotes a fairly valued company and supports a PEG ratio of 1 even. When a company's PEG ratio exceeds 1, it is considered overvalued, while a stock with a PEG ratio of less than 1 is considered undervalued.
And yeah, and I talked that a lot on past shows, right, Patrick? I mean that's the
Yes.
benchmark that I learned. So, but not always the
Mhm.
case, and we will show you in the future why not always the case. So, let's go.
Okay, so to continue, an example of how to use the PEG ratio. The PEG ratio provides useful information to compare companies and see which stock might be better might be the better choice for an investor's needs as follows. Assume the following data for two hypothetical companies, Company A and Company B. So Company A has a price per share 46. The EPS this year is 209, $2.09 that is. EPS last year $1.74. Company B, conversely, has a price per share of 80, EPS this year of $2.67, EPS last year of $1.78. Given this information, the following data can be calculated for each company.
Go back for a second, Patrick. Let me look at those
Yes.
numbers again. That was a little quick. So company A, price per share, 46. EPS to this year, EPS last year. Okay. And then company B, gotcha. Okay, so one price per share is almost double the other, where the EPS are similar for this year and the next year, or the previous year. Okay, gotcha.
Okay. I'll continue.
Yes, sir.
Okay. Given this information, the following data can be calculated for each company. So, company A, the PE ratio is equal to 46, equal to 22 by doing the math. The earnings growth rate is 20%, again, by doing the math here. And the PEG ratio is equal to 1.1. So here you have the PE ratio of 22, you have the growth rate of 20, and here the metric is 1.1, so some might say that might be slightly overvalued. Company B has a PE ratio of 30, earnings growth rate of 50, and the PEG ratio, you take the PE ratio of 30, the growth rate of 50%, that gives you 0.6 as a PEG ratio. So
This is
here,
good.
company B
This is
is
good.
more is more attractive because of this lower P ratio or PEG ratio. That is
Yeah, PEG.
the PEG ratio. Many investors may look at company A and find it more attractive since it has a lower PE ratio between the two companies, but compared to company B, it doesn't have a high enough growth rate to justify its PE. Company B is trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earnings growth. And that is it.
Man, Patrick, we should have showed this like 6 months ago. We've been talking about PEG
Yes.
ratio, PEG ratio, PEG ratio. That's it. That's pretty clear. And
Yes.
anyone who did not follow can rewind on YouTube and take another look at it. But or you can just go to Investopedia and just take your time.
Yes.
So pretty good, Patrick. So any closing remarks on that before we go into PEG ratio by sector? Any comments there?
Um, yes. So one would, to value a stock, I mean, PEG ratio is just like another really good metric, another popular metric. Um, and the PE ratio is also fairly good. But again, you want to look at the complete picture in terms of valuing a company. You want to look at the debt to equity ratio and other metrics, and then compare these metrics to those in the same industry.
So how would you stack the price to sales versus the PE ratio versus the PEG ratio? For me, I look at a PE ratio to see if a stock is expensive, and then I instantly go and look at the growth rate to calculate the PEG. And you don't even need to calculate the PEG. On most sites, they give you the PEG. So, but I
Exactly.
always want to see that PEG ratio. The PE alone gives me a quick indicator. Typically, my number is around 20. So if it's above 20, I know it's elevated. And so then I want to look at the PEG to see is the growth rate at least 20, to keep up with such a high PE ratio. And so, which one is more important, in terms of ratio? How would you prioritize those price to
Yeah,
sales, PE, and PEG?
Depends. It depends upon the situation of the company. I mean, if it's a again, if it's a growth company that has IPO'd
Hmm.
but doesn't have a good earnings track record, I would say go with the price per sales
And compare that to other companies in that industry.
in that
M-
industries
Meaning
or
compared to
other
its
IPOs
competitors. Meaning compared
compared
to
to
its
its competitor.
competitors. Okay. Because
Exactly,
that's
especially other companies that don't have a track record of earnings.
okay. So then let's go PE ratio and PEG ratio. Where do you put those? Do you have similar sentiments as I have? Do you, how will you prioritize those?
I would say definitely the PEG ratio is more important because you're looking at growth. I mean, the PE ratio, I think that just kind of gives you a gauge as to where the stock is relative to maybe certain benchmarks. Again, you have to look at the industries.
Right.
You
It,
have to look at each industry. So a PE ratio of 80 is not necessarily bad. A PE ratio of 12 is not necessarily good.
that's right. It depends on if the company is growing.
Yes,
Yeah. So a P ratio of 80 and the company is growing at 50%, that's a good PE ratio. And the PEG is
right,
what gives you that indicator to tell you that. Just divide it.
exactly.
Okay. So, Patrick, how do we find out what's the benchmark or what's par? What is the acceptable limit of expensive versus cheap in a particular sector when we're looking at PEG ratio, since PEG ratio is more important?
Okay, well, what I've done is I've unearthed a spreadsheet provided by Stern School of Business at NYU, and this is, I think, pretty helpful. It gives you a pretty good gauge. Keep in mind, this spreadsheet's almost a year old, so this data may have changed significantly over the last year. So let me share this screen.
Okay.
So what I have here is this is something I downloaded from NYU, and these are the various industries here. In this column, you got the industry name, you got the current PE, trailing PE, forward PE, the expected growth over the next 5 years, and then the one that's in bold that I bolded out is the PEG ratio. So as you can see, various industry groups have different metrics. So, for example, you might look at the aerospace and defense. Um, the average current PE, that seems a little high, but anyways, 291.56. Trailing PE ratio is 107.38. Forward PE ratio is 122.37. The growth rate over the next 5 years is 5.78% with a PEG ratio of 355.
So that
So
is
that's
for
the
a
industry
so that's the average for a particular sector.
for a particular sector. Exactly.
Okay. So how would I use that information, Patrick? Let's say I have stock in the Boeing company. That's a pretty popular aerospace defense company, or Lockheed Martin.
So
How
what
would I use this information in comparison to that?
so what you would do is you would go to Yahoo Finance or other reputable um, investment site. Morningstar is another good one, and you would take a look at the stock in in question, such as Boeing. And what you might want to do is compare Boeing to that of this um, of this chart here, we're highlighting the aerospace defense industry. Compare the various metrics there. So right now I have the expected growth for about the next 5 years, and then we look at the PEG ratio at 3.55. So what is Boeing PEG ratio? What is Boeing's PEG ratio?
You want me to look it up?
Yeah, just look it up really quickly.
Okay, I can do that. Let me type it in on my other monitor here. BA Boeing PEG ratio. All right, and then I'm doing Yahoo Finance, by the way.
Yes.
And so I'll go to statistics and the PEG ratio. Ooh, it's expensive. 6.53. Ooh,
Okay.
currently.
And what is the projected? What is the projected growth rate over the next
Oh, the
5 years?
projected growth rate. We'll go over in Yahoo Finance to analysis, go to the bottom of the page, and next year, well, next year they show 343% growth rate.
Okay. And what
Yeah,
about the next 5 years?
that's 5 years, 20%.
So, yes, the PEG ratio is more expensive. However, it seems as if the growth rate is also elevated.
Good point. Okay. All right. So, Patrick, this chart, can we get a link to this so that I can put it in the description so people who are following us can find this in the future? This, where's this coming from again?
Okay, so this is coming from. Okay, so
Can
this
you
is
blow
start.
that up?
You
Is
know,
it? You might not be able to blow that spreadsheet up. Be good.
well,
No, yeah, you
it's on
can.
because it's on the website. Sorry, because what I did is I imported an Excel spreadsheet into Google Sheets,
I'm just saying
and
blow up the link so that people can see it on the screen
okay,
in case they just
yeah,
not want to go to the description.
so this is it right here. So homepage. So this is created by Aswath Damar. Dam, hope I'm pronouncing his name right. Damaran, and this is his website here, damadaran.com, and this is the data website, http, so that's www.stern.nyu.edu, and then the rest of the URL
Yep,
is
gotcha.
there.
Yeah, send that
And
over to me, Patrick, and I'll put it in the link. Appreciate the likes. If you guys are finding this content informative, we appreciate it. Get to share with our loved ones, and especially I want to share this with our babies. I love our parents to share this with our up and coming generation. Continue, sir.
okay, um, so
So,
that was one industry group here.
so Patrick, I know we are very fond of NVIDIA. Using
Yes,
this,
we are.
how would I know how to compare NVIDIA? So,
So first thing you want to do is compare it to the other members of the semiconductor space.
okay, so a semiconductor. Alrighty. Okay, let me get myself out the way. All right, so what am I looking at here, sir?
So right now you're looking at semiconductor, the current PE ratio of 1,291. Ooh, that seems a bit high. Trailing PE ratio of 726.52, and forward PE ratio of 44.34, with an expected growth rate of 13.63%, and the average PE ratio in this space is 2.3.
Would
So
you?
now take a look at NVIDIA on
Oh,
Yahoo Finance.
yeah. I'm gonna go to statistics, and Are we looking at the PE ratio?
You can look at the PE ratio, but look at the PEG ratio as well.
Okay, so forward PE is 61
Okay.
and PEG ratio is 3.36.
Yes. But what's the growth rate?
So in Yahoo Finance, I would then go to analysis, go to the bottom of the page, next year's growth rate, 19.8%.
So that's more than the average. What is the 5-year growth
The
rate?
5-year growth rate is 39.37% as of
So that's almost
today.
Yeah, so that's almost about 3 times this metric here on the uh
What is
on
that
this
metric
particular.
there? That's kind of small. What is that metric saying, sir? Sorry.
Yeah, so the expected growth rate for the next 5 years is
For the
13.63%
industry, for the semiconductor
for the
industry.
yeah, and the average peg ratio is 2.30. So you'll probably have a few laggards there.
Also, it makes sense. That explains why NVIDIA is more expensive.
Yes, because it's people have taken the stock and they've probably used some kind of interest rate to calculate the price of stock, and they figured that it's going to be so high that in the future that you know the PE ratio is probably really high, and the growth is also pretty high.
So that's why it's important to not just look at the metric, but put some sensibility behind the metric as well, right?
Yes, put some sensibility as well. Look at the corporate balance sheet. The corporate balance sheet is very, very strong.
So can I go through a couple of stocks in comparison based on everything we said there? Let's
Yes.
uh let's go over a couple of ones here. So let's do a couple of based on what we just said. Let's go over a couple of companies. Let's look at Nvidia versus AMD, Patrick. Let me see
Okay.
if I can share my screen here and
Okay,
do
so I'll
that.
stop sharing,
Yeah, once you stop sharing, I'm going
and
to
which I've
blow
done.
this up a bit. And I'm going to go right here to Yahoo Finance. And I'm going to show what I was just doing for our audience so that they can follow along. We just went to yahoo.com, clicked on finance. And then once you're in finance, you can put in the ticker symbol there. And then it will pop up here at the summary page, actually. And then from the summary page, I go to statistics. This is what I was doing in the background. And then I was also going to analysis here. So that's what I was doing. So if I were to look at NVIDIA and go statistics, and let's blow this up, then what I was actually doing is going with the current, and then I was looking at the forward PE, the PEG ratio, and here's the price to sales, which we haven't talked about much here as far as doing comparison, but we can do now. So this is what I would look at here. So this is NVIDIA.
Yes.
So why don't we take a look? You think you could remember this, Patrick? A
Yeah,
PEG ratio of
3287.
3 so we're paying 3 times growth,
Mm-hmm.
32 times its revenue or sales, and 61 times earnings. All right. So let's
Mm-hmm.
look at it. 61 times earnings. This company better be growing. So then I would go over to analysis, click on it, and then go to the bottom of the page, and then look at what is projected to grow next year, Patrick. 28.6%.
Mm-hmm.
That's next quarter. Sorry, next year 19.8%, and then over 5 years at 39%. So
Mm-hmm.
that's That's the reason for that premium. So let's go back and then let's go and put in AMD. And let's see if AMD is biggest competitor, how that stacks up in comparison. Okay. So let me go to statistics and let's blow that up. So forward PE of 46, PEG of only 1.37, only 12 times sales. Wow. Do you remember what NVIDIA was? You have a good memory. I could click back and just look at it, hopefully. No, I can't.
Well, the PEG ratio for NVIDIA was 3.36.
Okay, so let me go to analysis and look at the expected growth rate of, so next year, 26%. And over the next 5 years, 35%. What is the better play in this inflationary environment, Patrick?
AMD. Absolutely.
There
Absolutely,
you
AMD.
go. But we've been hopping NVIDIA. So, there may be more to this story, right? I mean, just looking at the metric, but this makes a really big bullish case for AMD. So let's do another one. The audience can decide for themselves. Let's do Ford. We've been talking Ford. Let's compare Ford to Tesla and NIO. All right, so let's do the Ford Motor Company and see how those metrics compare. So I'm going to go up here. Let me share my screen. I'm going to go up here and do this. So I'm going to put in the letter F for the Ford Motor Company. And then I'm going to go right to statistics. And I'm going to blow this up. All right. So, Patrick, you're going to have to, and we are on the current column. So, we will look at forward, not trailing, but forward. This is the projected earnings, projected profits that Ford is going to make. So, we're paying 10 times the projected earnings right now. Only 0.18 PEG ratio, so the growth ratio. So this seems pretty cheap. And only 0.6 to sales.
Yes.
0.6. We're not even paying one-time sales. Fairly cheap.
Yes.
Okay. Now, Patrick, you think you can snapshot that in your mind?
Yeah. I mean, I could probably just try to write it down.
Yeah. 10.18, 0.6. I bet you Tesla does not have these type of numbers. But Tesla is projected, it's the world dominant EV, electronic vehicle play. You have those down, Patrick?
Yep.
Okay, so let's go Tesla. Let me blow this out a bit.
Oh, what's the growth rate?
Oh, yeah. We didn't do the growth rate. Sorry about that. We'll go to analysis, and we'll go to the bottom of the page, right? And we'll go with the growth rates right here on this first column. So next year, 2%. Over the next 5 years, 77%. Oh yeah.
Okay.
Next year,
Absolutely.
Next year, 2%. But guess what I'm betting on here, Patrick? My bet here is that this next year projection of 2% under Jim Farley, we're going to have an earnings surprise. And that's another factor. Just because you see this stuff on Yahoo doesn't necessarily mean the estimates are correct. A lot of companies surprise and beat the estimate. I'm betting that Ford would beat them. But for now, we'll leave it where it is, okay? Yes. All right. So you have that written down, Patrick?
I do.
All right, perfect. Okay, so the next company we'll look at is Tesla. We're going to compare this electronic vehicle company to the Ford Motor Company that we've been talking about ad nauseum for week after week. We'll go to statistics here. We'll blow it up. All right. Forward PE. This is what you're paying times earnings for that Tesla company that costs $1,000 a share. For it only costs $19 a share, but really this is where the value is, right? So 131 times earnings. Look at the PEG ratio. 2.87. And then price to sales, 26 times sales. That's what you're paying for in the current $1,000 a share price of Tesla. Let's look at the growth rate to see if this PE ratio makes sense, okay? So we would expect a large growth rate to justify such a premium in price. And so come here. Oh,
What is the growth rate?
34.8% next year. 34.8%. And over the next 5 years, 73%. And they're currently the leader in the world. So to be such a large market cap company and still grow at 73% over the next 5 years per annum, and 34% next year, with almost it is a $1 billion market cap company, isn't it? So wow. So no wonder that the forward PE is 131, but still pricey, Patrick.
Yes.
Still pricey in this inflationary 10-year yield rate going up type of environment that we described earlier.
As compared to Ford's 10 PE ratio and PEG ratio.
I got to go back to Ford. I mean, it's just so much cheaper, but again, it's not the same company, you know? It's definitely not the same company, right? It doesn't have the same growth rate and, but the numbers, you're paying 10 times forward earnings. Right? You're paying over 100 times forward earnings.
Well, Tesla to me is a hybrid company. It's you could say it's automotive, but you could also say it's a tech company.
That's true. Yeah, I mean it has more. And the Ford Motor Company is truly just automotive, right? It's just a pure play.
Yeah.
So now let's go NIO.
Yeah.
Sorry, go ahead.
Although Ford is becoming more technological oriented.
Let's go NIO. NIO. Look at NIO. Let's go statistics. It's a popular company.
Okay.
Ooh, Patrick.
What's going on?
For NIO, at the current price of the stock, you're paying 526 times forward earnings.
Yes, I would agree with that.
Ooh, that is very expensive. There's no PEG ratio, 11 times sales. So that's
there's no PE ratio either.
Yeah. So that's a little different, a little crazy.
It's got a negative enterprise value. I'm looking at that too.
Yeah. So it's losing money. I'm live on YouTube. What's up?
Your screen is blurred. You can't see it.
Oh, okay. All right. I just got contacted here. Okay. So yeah. So all right. And then let's go to analysis. And
to me, just another point is that NIO is one of these Chinese companies, and there's political risk involved there.
Okay, perfect. Yeah, and then let's go to growth rate, Patrick. So the growth rate is look. So next year is projected to grow at 71%.
Okay.
Projected to grow at 71% next year. But look, over the next 5 years, the estimate is estimate to lose 0.15% in growth. completely understand that. It sounds a little risky.
Well,
Why?
that might be because of again, it could be um, political risk in China because the current president, President Xi Jinping, is becoming more authoritarianism, and he is more anti-free market. He's
Okay.
more socialist. He's more for a centrally planned government
Ye-
and controlling the economy. So
Yeah,
that's probably where that growth is coming through.
yeah, and I heard my screen is a little blurry, so sorry for that. I was trying to show my screen, but I think people got the gist of what I was attempting to do there. But yeah, thanks for letting me know my screen is a little blurry. So anyway, that's kind of it for today, Patrick. That's kind of what we wanted to share. Oh, we had another one: Disney versus Netflix. Let's take a quick look
Okay.
at that. Let's go do a quick look at Disney versus Netflix. So Disney, Troy, you keep talking Disney, and this screen is this screen really blurry, Patrick?
I don't think so.
Mm.
Yes, it is a bit.
It's a bit blurry, but I hope you can make it out. So,
I mean,
just looking at Disney, Patrick, just very quickly, the forward PE 32 times. PEG ratio is not even 1, which is good, less than 1.96 currently. 4 times sales. Okay? That's Disney. You want to compare it to Netflix? That's what
yes.
the analysts are doing, so why not? Why not compare it to Netflix? So, net. It's FLX, yep. Oh my goodness, I put in an extra little thing there. All right, let's do that comparison quickly and go to statistics and blow that up and current. So, ooh, Netflix. I might need to get out of this Netflix. It's scary in this. 51 times forward. We'll have to look at the growth rate. The PEG 1.63 and 10 times
That's pretty
sales.
good.
Yeah, yeah, the PEG is not bad. Let's go look at the growth rate. I didn't do it on the other company, I don't think. But we'll go down here. I don't think I did it on Disney.
No, you didn't.
So next year is 22%, and then over the next 5 year per annual, 42%. So you get a good sense of that, right? So
Yeah. So Netflix is well established.
yeah, and 42% over the next per annum, next 5 years, 22% next year. Does that justify Netflix to have that type of PE, Patrick?
Uh,
51
well,
times
what?
forward? Ooh, that's a little expensive, my friend. But the PEG ratio, 1.63. And you know what's good is you can look at the previous PEG ratios and you can see in the past it's kind of in line. It's lower compared to it was a year ago in 2020 here. Let me blow this up a bit. But if you look at the PEG ratio here and you do, it's at 1.63. It's relatively inexpensive compared to a year ago. It was at 2, a PEG ratio of 2 back in September of 2020. We're both in the way, but that's September 2020 above there. So that's something to consider for Netflix. But then if you go and look at Disney's growth rate, and we just did Disney, you can be the judge. And just to throw that chart back up there again, the key indicators, that 32 times and that cheaper PEG ratio. Now check this out, Patrick. Look at the expected growth for Disney. You will see why I'm so bullish, why I put in a little over 40 G's over the last 2 weeks in this company, which I'm willing to say on camera. But look at this. Next year, 31% per annum, 40% expected growth rate. Patrick.
Those are good. Those are good.
I mean, you just look at the numbers. You don't have to be a rocket scientist or an engineer or an
Hmm.
accountant to figure out those. So those are the key indicators. Hopefully, you guys learned something about valuation, 10-year treasury, PEG ratios, and PE ratios, and price to sales. And this was very helpful for you. So, you want to wrap it up, Patrick? You have any closing comments before we wrap it up?
All I like to say is do your due diligence on these various stocks.
Yep.
Do your due diligence. Do your comparisons. These are just some of the tools. Get the whole picture, and dollar cost average when you figure out the stock that you want to buy. You don't buy it all at once.
Yeah, and yeah, if you like, we appreciate the likes, guys, because that let us know that what we're providing is valuable. So even on the replay, guys, if you appreciate it and found the content helpful, like the video, and also you can support us at buymeacoffee.com if you feel the need to do that as well. So. Patrick, I'm going to wrap up the show now. So we do this. So this has been the Bet Out of Debt Show. We call it the Bet Out of Debt Show because when you place a trade, it's called placing a bet. And hopefully it's a winner one to keep you out of debt. And as always, keep investing and we will see you next week. Same time, same channel. Goodbye.